Next up, we have Neil Roberts with Harmony, another successful disruptor.
Thank you very much.
Thank you, Neil.
Cheers. Thank you. Do we get to keep the lights? Do we go on quicker? So Neil Roberts, Harmony. I'd like to tell you a story about 2001. I learned something really, really important. Someone said to me, if you put an ad in the paper and ask for some money at a couple hundred basis points more than bank, money will come in. So we launched a debenture product way back in 2001. And I said, you must be nuts. We put an ad in the paper and 6 weeks later, money was coming in at 100 basis points more than bank. Unbelievable, it kept coming in. We were the 13th issue in New Zealand, and some years later there was 120 issues, and we all know the history of that. Why was I in that position? Well, I convinced a group of sane people at the age of 27 to give me 1.2 billion, rose off the tongue, $1.2 million in capital to actually start a business. Started a business where we raised deposits on one side, personal loans on the other. This wasn't Harmony. And 6 years later, we've done 3.2 billion in applications and about 1.6 billion in written business. Cool, pretty successful. A bit like Sam, I actually went to Australia, took some of the team with me. That team's with me today in terms of Harmony. But a bit like Sam, when I was on the plane going over to Australia, I questioned myself: are we really doing a great job? It felt okay at the time. Happy customers, happy depositors. By the way, that business was bought by GE and everybody got paid out. Nobody lost a cent. So, but was I really happy with what we'd done? As a young fella, I thought good customers, we paid everybody, great. Team learned, fantastic. And the answer was no. Spent some time in Sydney, came back and saw that there was a once-in-a-lifetime generation change in terms of the law, and peer-to-peer was about to be enabled. So you could actually, quite a high bar, so actually quite a suitable high bar to get a peer-to-peer license. But what you had, it gave you the opportunity for borrowers to actually list their security on a platform and not have to do a prospectus, right? So having been trained in the corporate world, spent 2 months, two and a half months, analysing the opportunity, to the point where we worked out it was an absolutely ridiculously crazy thing to do. We didn't know whether we could get it funded, we didn't know what the regulations were going to be, we're obviously in a small market, but we decided to do it anyway. So what is Harmony? Harmony is a peer-to-peer platform. On the one side, we attract borrowers, we credit rate them, we credit rate borrowers to 30 credit grades, we price each rate accordingly, and then we put it in the marketplace, and lenders, mum and dad lenders, along with institutions, come in and they choose to lend against that loan. From a technology point of view, after we've taken the borrowers through a completely automated process, we take a $15,000 loan and we break it down into $25 pieces. Sam is far smarter than I am, because doing that costs a fortune from a technology point of view, I'm sorry. It absolutely does. In fact, we spent $25 million on the business so far. We raised that money here in New Zealand, as well as in New York and in the UK. We have $300 million available to us right now to lend, and in fact we've got unlimited access to lending capital. We didn't know that when we were spending money building the platform, and every day when I was drawing money out of my own bank account, tax-paid money, and investing it and paying wages, people would ask, well, will Kiwis put any money in this after the finance company debacle? Truth is, we didn't know. Have they? Well, 50 million so far in 22 months. And how they're doing? About 13% after costs and after losses. That's 1-3. So we have 15,000 active investors right now in 22 months. We have 20,000 borrowers. Of those 15,000 investors, about 5,000 come in every day. And they literally go into our marketplace and they act as lenders. They see a deal, they don't see who, by the way, but they see a deal, they see the person, is the person married, is the person does he own a house, or she own a house, what's their credit rating like? And we have some great stories. We have grandparents teaching their grandchildren about risk and reward. It's a real live marketplace. Borrowers are telling their stories, saying why they wanted the money. So to date we've done 300 million in actual lending, 2 billion in inquiry, and we're 22 months young, we're very proud of what we've actually achieved. If you look at our feedback, we run NPS score, so Net Promoter Score. Simply means, would you recommend us to your friends or family? We're currently 72.4 from borrowers, to give you an idea. And to give you an idea in context, for those that you don't know, Net Promoter Score, that's above Amazon, and it's above Apple. So we're pretty pleased with that. We have 45 engineers and head office staff, if you like, based in Parnell in Auckland. It's the guts of the business, and then we have another 40 people in Fiji. That's probably it from me in terms of an introduction to Harmony, and look forward to joining the panel.
Thank you, Neil.
Thank you.
If I could just invite everybody up here, and we will form our panel. I'm looking forward to some great discussion around for a lot of us to get our heads around where this is all going. Because fundamentally what we've talked a lot about is kind of the retail sector, more or less. There's a lot of questions around, where wholesale funds, fund management going, where's the banking sector moving to? You've talked a bit about insurance, Richard. So probably, Neil, why don't I start with you?
Sure.
So you've attracted all these mom and pop investors,
Yep.
that kind of got scared off during the GFC. So where is this all evolving? What's going to happen to all the to the not normal deposit takers, to the banks? Where do you see that all moving 10 years from now?
10 years from now, well, what's a good story? One of our funders. So we have two permanent capital funds, one out of New York, one out of London. They're brand new. They invest in alternative finance around the world. So I had a very privileged opportunity to go to New York and join a conference which was all about chasing alpha. It's all about how much we as consumers pay in the good times and how little we get back in the bad times, and how over the long term the fees attached to chasing alpha, so trying to get above market return, just don't actually work. And I think there's a global recognition of that. And it comes to the heart of the fee matter that Sam used. So this American fund, it's a mutual, it's permanent capital. It's promoted by financial advisors. That financial advisor group in the US controls $7 trillion in wealth. $7 trillion. Now that's the wealth of New Zealand and Australia combined in that financial group, financial services group. Sorry, financial advisor group. So, look, dealing with Sam, looking at where Sam's going, obviously we're an absolute advocate for bringing technology, for bringing what was a wholesale asset class. Let's face it, retail, consumer finance has been attractive. It was attractive through the GFC. It's fairly consistent. It's well spread if it's well run. So bringing the index to the consumer, bringing what was a wholesale only investment opportunity to consumer in an index in a way that's well informed and people can access, and the fees are reasonable. I think fundamentally will threaten or change the way that people invest in the future. I don't think that my children are going to be investing in what we do today, which is sinful. We pretty much pour concrete in our own house, and we buy term deposits. Pretty much. We don't do too much else. We're getting forced to do a bit of KiwiSaver, and unfortunately, the trend that I don't like to see there is actually people are perhaps drawing more on their mortgage, spend it on consumer goods because they feel safer because they've got a KiwiSaver. So I think our grandchildren certainly will be accessing a whole range of alternative finance, and they'll get it that chasing alpha doesn't work, paying high fees doesn't work, and you've got to get tax breaks. So I think fundamental change in the future.
Sam, some comments on that?
Yeah, look, I completely agree. Look, I think about the finance industry, or many aspects of it, pretty much like a priest reading a Bible in about the 16th century, which is that everyone went in there and no one could read, so the priest was the keeper of all knowledge, and you had to believe what they were saying. And 16th century Bible and many investment statements are not that different, actually, except one of them is written in Latin, which is a lot easier to understand. So, look, I think that absolutely right, that the finance industry makes one fundamental mistake, I think. They think their customers aren't as smart as they really are. And they really are smart. People make very sensible decisions every day of their lives about most things that affect their lives. When it comes to money, once presented with the truth and the tools to understand or read the Bible, then they will make some very smart decisions. And you can see that because they've done that in every other industry. Every single time people are given more knowledge and more understanding, they end up making smarter decisions, generally. There are some mistakes, but they generally make smarter decisions. So I think what the finance industry has to embrace is basically demystifying money. money's really easy. Money's not hard, but the industry wants you to think it's hard. So just give us your money, forget about it, we'll look after it, we'll stick your balance on an app, and we'll sort it out. Trust us. I don't think that's how the modern consumer thinks anymore. I think the modern consumer thinks, I'll do that, I'll trust you once I understand it. And so what technology is doing is making information way more available, so much more transparent about what people are delivering, and I think people are going to make some very smart decisions. So, and I think that the institutions that grasp that, understand that, and recognise and are not scared of the fact that providing that information, providing those tools, deserves to be paid for, means that you just get a much more honest exchange. And look what happens when you do that. You know, look at Amazon, look at Google, look at eBay, look at all of it. They're just honest brokers of information for which they charge a fee, and then you get the power of scale.
But don't you get pushback then ultimately from an entrenched industry? You know, there's some big money at play here, invested interest, and if you talk about, fundamentally what we're talking about is the Uberization of the financial services, and if you use that as an example going forward, you know, you look at the pushback not only from the sector here in New Zealand, but also from the regulators. You know, so
but you know, I hear you, but I think the financial industry is full of wonderful people who mean really well. They're just trapped in business models that want them to make ever more money every year. So the threat is on behalf of the shareholder. So when I say short the banking sector, that's, you don't want to be a shareholder of banks, but you sure as hell want to be working in them because they perform a very valuable function. They just have to be given the opportunity to reshape how they interact with their customers. And sorry, I sound like I'm picking on banks. It's just, there are just aspects of the whole industry that have these attributes. And I think that because if you don't do it, it's going to happen to you. Because man, if you think that there's not an Uber of the banking industry just around the corner, you're kidding yourselves. And think what happened with the taxi industry. It's interesting when you use Uber, just to use this as an example, because we use this. People Uber everything, right? So all the trendy words is Uber. But think about the emotional journey you go through with Uber. The first thing is, wow, it's so easy, right? 2 clicks, awesome. And then you go, wow, it's so cheap, right? But I don't know about you, but there's one part of Schadenfreude in my mind which goes, thank God I'm shafting those bloody taxis who've overcharged me for decades, right? And you also think, man, what a massively inefficient, exploitative industry that is. Taxi drivers getting paid nothing, huge oversupply when you get into the airport, huge line. How can that possibly be economically efficient? So if you think about that, if you think about the emotional journey you go through, I think that's going to be a very similar one with financial services. So the terrible bind, when it's a prisoner's dilemma, the industry's now, and it's making too much money. And no one can go to a senior manager and say, I want to do this, it involves us making less money next year. Yes, you've got to be joking. Don't even think about it. So you end up tweaking a business model, and the problem with that is that particularly banking, but also other aspects, have been considered moat industries for a long time. They said no one can crack the distribution nut, right? And no one can move, and that's why I mentioned that Mark Carney thing. If you get number portability in banking when you can move in a click, man, you're going to make a really sensible series of decisions about what's good for you, right? So if you are relying on a moat to protect your industry, and you think that Warren Buffett's got it right for the bank, you know, if Warren Buffett's philosophy is right for the banking industry, I don't know. You're seeing that's 3.5. I think Sovereign have got some pretty clever products too, but at least 3.5 people are telling you you're absolutely wrong. And if you had thought that you could have done peer-to-peer lending 5 years ago in New Zealand, you were kidding. If you thought you could have done annuities in New Zealand or lifetime income, you were kidding. If you thought you could have had a KiwiSaver scheme that might charge you $50 in 5 years' time, even if you got $1 million invested, you'd be kidding. It's all happening. These are real businesses, and it's happening real quick.
So, you know, I think what's interesting about these comments are, so then financial institutions kind of got to change what it is that they actually do, right? Which is, you're not just bringing money in and sending it out. You actually become, well, you got to reinvent what you do, and certainly this whole area of advice becomes a place where, to a point I agree with Sam that knowledge in the hands of the people, they'll make the sensible decision, right? But we're all living in pretty complex worlds, and the older we get, the more things we accumulate, and the need for someone to either coach us, guide us, help us make sort of smart and sensible decisions about whatever it is in life, I think is one of the areas that is probably untapped.
To provide a personal interface to the technology, fundamentally, at some point.
It's partly that, but it's also kind of going, so which is the right fund? I mean, if we're now living in a world where to buy an asset, to buy a managed fund, you're paying 30 or 50 bips or whatever, or which is the right one I should go for? And do I need a lifetime annuity in my retirement plan, or will the dividends actually pay for the lifestyle I want to lead? And stuff like that. So this notion of big institutions then have to start to go, how do we actually package what we do and make it relevant to our consumers? Because ultimately that kind of consumer experience becomes the battleground for the future. So, yeah.
All good points. And, Ralph, I just want to touch on what you're doing for a second and tying into Sam's comment earlier that, a lot of this is very much an emotional journey.
Yes.
And particularly with your market segment, lifetime income, you're dealing with an age population that I think could be very intimidated in the first instance by technology.
Yes.
But it is truly an emotional journey because a lot of them have lost a lot in recent memory. So how are you kind of coming to terms? How are you, getting your product out to those people and convincing, a market that's totally suspicious, I would imagine, in the first instance?
A couple of answers. Want to sort of comment on the first question as well. It's almost like changing CDs in your mind. The dark suit example was a practical one. Most of my working life was incentivised, paid, and motivated to generate more funds under management and drive more profit. So different widgets, different mousetraps, whatever it took, get more funds under management. Grow the business because that's how you drive. That was our revenue model. In retirement, the needs are so different. You just got to think about that completely differently. So where there was the notion of growing my fund management book and being a hero and all that good stuff and corporate profits and great bonuses, to really satisfy retirement needs, they want certainty of income. So you can imagine a triangle, and there are 3 corners on the triangle. So on one corner is a person's age. On the other corner is the likely level of income they need to have a good life in retirement. And the last corner is how they invest. If you consider each of the 3 corners and offering a guarantee, the investment piece is actually the easiest to solve. And it's the one that you do exactly what Sam's done, is you dumb it down to hell. It is Vanguard, it is low cost, it is balanced, and you reduce volatility as much as humanly possible. So in fact gets the least attention. So it's a mind flip in retirement. In terms of experience, we've had, only going for 5 months, we've raised about $10 million of new investor funds, and it's going well for us. The reason I'm late is we did a seminar in Hamilton and Cambridge today. We've talked to about 1,000 people. We just run a simple ad in the newspaper that says practical retirement income solutions. Then we have some nice words underneath, but that's all it says. First one we did was at Kapiti Coast in Wellington about 3 months ago. How many people do you think came? Anyone guess?
200.
Thank you.
200?
500. We had to hire out the car museum there and have 3 sessions. This
Must have been free biscuits.
They did. But the level of retirement awareness for income issues is just huge. So our task is to do functions like that, but also help people have trust and confidence in
That's
the offering.
the key issue, isn't it? The trust and confidence.
Exactly.
And that's probably a good point to open up to the audience. For some questions.
I was going to say, people fear loss a lot more than they I guess, look forward to gain. So the big challenge, and the reason why this disruption hasn't already happened, because we've got enabling legislation in New Zealand, we've clearly got the technology, and we've got some passionate people behind this. What's holding it back is establishing credibility, I would suggest. And so I guess I'd like to hear all your thoughts on how you go about doing that.
Yep.
If you want to bring something that's really disruptive.
Ours is really easy. We've got a number of products we are interested in the market that are hugely overpriced, but KiwiSaver is the obvious first entry because, and this is going to sound terrible in front of the regulator, but you get to borrow the brand, right? KiwiSaver is the first product I've seen in my career where it's trusted fundamentally trusted. In fact, most members still think it's government guaranteed, which is its own problem. And so, you know, the regulators and the pods are quite carefully nurturing and protecting the brand. But boy, do we need it. We've got to have a trusted brand name, and having the big players attaching their names to it only enhances the credibility of it. So I think that's trust is, so we chose the most trusted product. It also happens to be the one that needs the least capital. So that's you know, that helps as well. Yeah, so that was our rationale about trust. But man, KiwiSaver, it would be a disaster if something went wrong in KiwiSaver, because it'll kill everybody, because the trust is wafer thin even now. You know, if someone lose money in everyone will be affected by it. So yeah, that was our logic.
We had two approaches. Sorry.
No, sorry, you go on.
We took two deliberate approaches. The first was with regard to regulation. As a mindset, consider the regulator as a strategic partner. So don't think of them as a regulator or as someone to be governing your activity. Think of them as a strategic partner. And I think in the long run, particularly with the Reserve Bank, it took a while, took years, but I think they saw it the same way as well towards the end. And second was we over-invested considerably in our board. So we went out and found people who specifically portrayed, had the experience and the knowledge to display trust and confidence.
We did a number of things. I think the very first thing that we did was we knew in a small market, and not being able to answer the question completely, will Kiwis invest in peer-to-peer, we felt that we needed wholesale funding to sit alongside retail. And why? Well, wholesale funders know their industry. They come and do due diligence, and you know, they strictly do it, and they watch you very carefully. And we felt that retail needed that confidence. Then, of course, we had a partnership. We applied for our license, and we were the first to be granted a peer-to-peer license. The bar's really high. It's not light touch. The way we operate, you know, is light touch, but it really is a high bar. And then we designed our model around fractionalisation. So taking our $15,000 loans and putting them into $25 lots. And we celebrated the day where in our first month, the average investment was $2,000. And the reason we celebrated that was because we did not want people coming in, and particularly people that perhaps may have been ill-informed or recommended by a friend. We don't want anybody to lose money. We don't want anybody to come in and put their life savings into peer-to-peer. You know, if they tried, we'd certainly tell them that wasn't the right thing to do. So that 2,000 in the very first month is now 12,000, and we're happy about that. We think that's great growth. It's grown along with the platform. The people that put that $2,000 in day one, they're investing more and more. And now we have 50 million, and we're delivering 13%, and we did month after month, and we. You know, online, live, you can see where we earn fees. You can see where our fees are. We don't take any interest income. That's the lenders. They take the risk. So it's that, and you know, we got some great press, and we have spent some money on marketing. We have 44% brand recall when it comes, if you unprompted in terms of, if you ask around peer-to-peer, 44% of the country in just 22 months will mention Harmony, and we're tremendously proud of that. Now, having said all that, I agree with what's gone before. You know, we as consumers, doesn't matter what it is in financial services, we kind of feel that we're getting ripped off, and that's terrible. It's a terrible heritage, and only time and trust and doing the right thing. And the good work, I think, just giving the plug to the regulator as well, because everybody else has, the good work that the FMA could do in ensuring that everybody, and does do, in ensuring that there's good conduct out there, and that's a cultural thing, and that people are focused on.
Are you
it.
feeling the love here?
Yeah. There's Commerce Commission in the room.
I mean, that's phenomenal. 13% return. Is that on the highest risk trance?
No, that's the index. Yeah, it's the
That's the index, the average.
So we publish those results.
Wow.
So it's not everybody's getting 13%. And
I'll be giving you my $2,000.
And people collect it tonight. You know, we are a startup. No, we won't. No.
Hi, I'm my wife and I work for Hanved strategic advice. And I've looked at robo-advice models previously, also overseas. I agree with you that KiwiSaver is a very important brand that needs to be protected. But within robo-advice models, first of all, I know that to set them up well, to use proper stochastic modelling, to really, set them up to work properly, costs millions and millions and millions of dollars.
Yes.
And Vanguard can do that because they've got 5.5 trillion in management, and they've diverted some of that money to invest over a period of years, and they've taken hundreds of programmers on board to build up their personalised advice services.
Yeah.
So they've really done a great job there, but it's cost a lot of money, and it's paid off for them very, very well.
Yeah.
Do you think that New Zealand will be able to do something like that, or do you think shortcuts will be made? And if so, I mean, the shortcuts that I've seen that have been made previously cause people to remain in growth assets till they're 55, which is a lawsuit waiting to happen. So how do you view the risks around robo-advice and it being quite opaque, being a bit of a black box, and people ending up investing in something that ends up ruining the commutator brand?
Good question.
Yeah. Look, I'm sorry I'm no authority on robo-advice, but from an investment point of view, I don't actually see too many problems. I see some problems in the nature of the capital markets in New Zealand which make it problematic with some form of advice, because you will assume, for example, liquidity in a security that may not exist, for example, or you will assume an efficient market in a market which is terribly inefficient, well, reasonably inefficient. So I can see those problems with the modelling. That said, just like Vanguard are managing our offshore assets, and we are just a tiny slice, infinitesimally small slice of a huge machine, I don't see why you can't import nearly all of Vanguard's technology down here. And you may have to tweak it a bit for the nature of our capital markets, but I don't see that being particularly expensive. I think that New Zealand has a homegrown attitude to a lot of these things. We don't. We have a completely, I don't know where our data is sitting, but it's in the cloud somewhere. And so if you actually approach that, if I was to approach robo-advice, I would say, I don't want to spend anything on it. I totally want to take on board what someone else has done. So I'd go to someone like Vanguard and say, how can you modify it for our market? And do it on a fee-for-service basis. And at that point, I think that, and robo-advice won't be right for everybody, because, the business of advice is a very complex advice. It's just not about investable capital markets. So, I don't really see a problem with it. But I do agree with you, it needs to be tweaked for New Zealand.
Yeah.
But anyone who tried to invent it in New Zealand, develop it in New Zealand for a New Zealand audience, they better have real deep pockets. Yeah.
But I think it's a very valid question, because what you've identified as a problem is black box risk, isn't it? To where suddenly, the advent of robo-advice, mom and pop investor running to that and willy-nilly, turning over all their life's wealth to a bit of technology that hasn't truly been, given the appropriate robustness tests, and you could have people putting in, inappropriate advice into that. So I guess that question, since we've given you all the love so far tonight, Mark, what does the regulator say about that space, and what's being done to make sure that there isn't this type of, kind of funny business going on in terms of these algorithms that are being
I'm probably
created?
not the right person to answer that question. We've got a couple of other people in the room here. Robo isn't something that's legal at the moment, because advice can only be given by a natural person. And then we've come out with the FAA review saying that it will be enabled, and there'll be a license applicable to that. So, if we get our job at New Zealand Link, do it right, then we'll have the same sort of thing as you've experienced with HARMONEY, where it'll be a fairly suitably high bar to get a robo-advice license to make sure those algorithms are trustworthy.
Yeah.
But it is coming. I mean, it's
That is coming.
Yeah.
Mark's absolutely right. I mean, it's under consultation at the moment, so the legislation hasn't been written. We don't have any regulations sort of coming through yet, but we're excited by the concept of what this will be able to deliver to the market. And sort of having a look at, we have a number of advisors already kind of approach us who are quite afraid of what robo-advice is going to do. And we sort of say to them as well, you need to understand what your value proposition is and actually what it is that you're actually creating for your clients as well. And when it comes down to it, I mean, investment is behavioural and actually does still require human interaction to really get it to work. But you have a look at the other end, you have a look at the younger ones sort of coming through, the younger generations who do everything off their palms. You know, they have mistrust for the human element and what that's going to start to mean as well. So you can feel and see all that journey starting to come through as well around what that's going to start to mean for all of them as well. It also opens lots of spaces that sort of says at the smaller end, so those who have smaller amounts to invest, where the banks or the larger advisors are not interested because they can't make any money out of it. So you kind of consider what that is going to start to deliver to everyone sort of starting to come through. It's education, it's learning, it's preparing them for the future in very different ways than it's been available to.
So closing that advice gap is the positive outcome
Absolutely.
of all of this. But also, and I guess that's what you've touched on, a number of you, and that's redefining the value proposition, isn't it? Because in the case of advisors, I mean, yeah, they're being disrupted clearly, but as long as they reinvent themselves and have a new look at what the value proposition that they're providing to their end user, as these gentlemen up here are doing largely, that's what it's all about.
Oh, I'm just itching to say there was two parts to that very valid question, I think. We're a very small country. The legislative change was, in a global sense, probably the leader of the pack, actually, in terms of, apart from the UK, and the UK happened because it basically wasn't, peer-to-peer lending wasn't regulated. But it's interesting on capital. We've got to be ahead of the pack. We've got to use this intelligent, small but highly adoptive population, and we've got to invest serious amounts of capital, because it does. I mean, you know, a silly old me, entrepreneurial, bump to the head and thought that we'd be able to create Harmony with 500 grand. Now we spent 25 million so far, and you know we think we spent it well. When we go to San Fran, you can see that they put a zero on that. So that's the Kiwi bit, that we can actually do it for 25 and do it well, and it's safe and it's secure. So I wouldn't underestimate the amount. So why would we do that in a small market like this? I mean, I've been in New York and sat with people and pitched to them, and they've gone, New Zealand, that's a country, right? Seriously. And the beauty about it is you say, yeah, and there's a bridge over to Sydney, and you know there's more people there. And no, you don't. I really do. But really attracting capital here, because overseas they have it. And if you don't attract capital here, if we don't innovate, if we aren't pushing the envelope here, and having the teams here, like 45 highly paid engineers sitting in Parnell, which we have at Harmony, others will bring their model here. That's the issue. And will be, excuse me, but little like the banks. Sorry, we have to be on the banks a little bit, and they do a great service. They are great people, but you know we're subsidiaries over here. You know, 80% of the market we're subsidiaries of Australia. Do we want that? And we have an opportunity right now to lead the world. We are small. We should be nimble. We've got a great, highly intelligent workforce. We need to engage them, keep them here, and develop these models and really embrace them and take them overseas. That's what we need to do.
Can I add to that too? That looking at the question through a different lens, I'd argue one of the offsets of disruption is unintended consequences. Because when you disrupt, you don't know. One of the unintended consequences we encountered was we are very actuarial rich. So we were able to attract a global actuarial firm called Milliman, who for our size and scale we don't deserve. So you ask yourself, why did you get that? And we got that because they wanted to go through a cycle of understanding how to launch a new product in a new market and the engagement with the regulator. And having that learning, they could use that learning as a marketing tool for themselves and other emerging markets. So that's why they did it. But the unintended consequence out of that is robo-advice and retirement advice is absolutely embedded. It's extensive in the US. And I can see ourselves hosting our data on Milliman's algorithms in Chicago and just bring it back here. It's not going to be that hard.
We'll see. There's a huge home bias here, right? And most overseas, Vanguard, for instance, doesn't have New Zealand as part of their models, right? So the fact that New Zealand, most investment managers here have a big home bias is a problem. Also, the tax structures are hugely different. And even looking between Australia and New Zealand, the tax structures do trip you up a little bit. So there are certain technical elements which I think you can't just take the models from Vanguard and plonk them here and just or from anyone else and just use them.
I do to disagree. I do think you can give them appropriate New Zealand data sets. They can crunch the numbers.
Okay.
Absolutely.
We're getting tight on time. Is there some other questions before we wrap up tonight? Frank, you've been entirely quiet tonight. You just got to be chomping at the bit over there.
Yeah, maybe I could just throw a couple of things in. The customer centricity that you talked about, I think, is very important. That business schools and universities have sort of for a long time been CFO centric rather than customer centric, essentially, and enabling better service to be delivered to customers at a lower price. That's got to be a good contribution to a better society. So good on that. On the annuity, I just wanted to ask, you talked about 5%. Is that inflation insured? And if you die tomorrow, have you lost all your money, or is there something for the estate? Because a lot of old people realize that when the estate looks like worth zero, the children stop visiting them.
No, completely. Sort of one of the fundamental innovations is that it has to be liquid. So an investor can have their capital back to their withdrawals at any time for any reason, and if they die, it goes back to the estate. And that's not indexed. The cost of indexation is still pretty high in a low interest rate environment. For example, it's about 45% of the total return. So I don't know if you do that in this environment.
Yeah, thank you.
That in that low interest rate environment that's the other hand grenade in the room, right? How does an industry which likes to charge 0.5 to 1% for a given service get away with that when you're making 1%? You know, you don't get charged that rate on your income tax. You know, your average KiwiSaver fee's now 25 to 30% of everything you earn. That ain't gonna work. That won't last. It can't last. So there has to be a readjustment. Doesn't mean there's not a great living for people in the industry, just that they get paid, I think, more like lawyers and accountants rather than bonuses in that sense, yeah.
That's probably a good place to leave it at, Sam, where we started at. And I am mindful of time, and everyone is needing to get home. So I'd just like to thank everybody. Richard, Nita, Ralph, and Sam, thank you guys so much for joining the panel tonight. Really enjoyed listening to your insights. Massey University, thanks for the sponsorship, CFA, and of course this lovely facility here at BNZ tonight, and Infants, all joining together in partnership to really talk about what is a very important topic that's going to be impacting all of us in the sector. So thank you guys, and a great audience, and thank you so much for coming along tonight.